Welcome to the deep dive. I'm really glad you could join us today. We're going to get into something that's, well, it's incredibly relevant right now for, just about anyone thinking about their finances.
Right.
We're talking about home equity. For so many people, it's not just like a line item. It's probably their biggest single asset. It's the bedrock of their wealth, really.
And that's exactly why we need to talk about it now. Because all these economic shifts happening, inflation, interest rates bouncing around, plus what's going on in the real estate market itself. These aren't just headlines. They hit that asset directly.
Right. So here's the big question for you listening in. What if that huge asset, the equity you've worked hard to build, isn't just sitting safe? What if it's actually kind of at risk of shrinking, slipping away?
Mhm.
And maybe more importantly, what if you could actually make that equity work for you? Like actively generate more wealth instead of just sitting there.
That's the goal of this deep dive. We're going to unpack what's really happening with home equity, especially with the market doing what it's doing. We'll look at smart ways to use it, to leverage it for growth, but also, crucially, how to protect it.
And we've got some really solid, up-to-date sources for this. We're talking practical stuff, real examples from folks in the real estate and mortgage world with data right up to, well, today, June 17th, 2025. This isn't theory. It's based on what's happening right now, especially in places like Florida and Georgia.
Yeah, those are key areas to watch. They often show us where things might be heading nationally.
Okay, so let's get into it. How can you make your home equity really count?
Well, the landscape is definitely changing fast. There are challenges, sure, but also some real opportunities if you know where to look.
So let's start there. Paint the picture of the current real estate scene. You mentioned Florida and Georgia are hotspots in our sources. Why focus there? What makes them, like, bellwethers?
It's a good place to start because, while every market's local, some places feel the shifts first or more intensely. Florida and Georgia. Well, after the pandemic, they saw this huge boom. People moving in, investors jumping in, massive demand.
Right. Things got crazy competitive there for a while.
Exactly. Florida's population, for instance, just exploded. Millions more people over the last decade, a lot of that recently. That demand, plus things like lower taxes, nice weather, it created these super hot sellers markets, bidding wars, prices soaring.
So they were kind of supercharged markets. What happens when that starts to cool off?
Well, precisely because they heated up so much, the cooling feels more dramatic, maybe happens faster. The shift from sellers having all the power to buyers getting some leverage back,
Mhm.
it's often more obvious there first. More houses for sale, houses sitting longer, prices getting cut.
Okay.
Yeah, our sources kind of call it a summer storm in those states that might signal broader weather changes. If you want to peek at what might be coming elsewhere, those are definitely places to watch closely right now.
That makes sense. And the sources are pretty blunt. We're moving into a buyer's market. For someone maybe not deep in real estate talk, what does that really mean day to day besides just supply and demand?
Think about it like this. Just a year or two ago, sellers were king. List a house, get 10 offers over asking, buyers waiving inspections.
Yeah, it was wild.
Total seller control. In a buyer's market, that flips. Suddenly, there are way more houses listed than people ready to buy right now. Supply is up, demand is softer. Buyers have choices. They have breathing room. They have negotiating power again.
Most prices tend to drop.
That's the direct result. Prices soften or drop outright.
Mhm.
Homes stay listed longer. You see more price-reduced signs. And buyers feel okay asking for things again, like repairs or help with closing costs. The power balance shifts noticeably towards the buyer.
Okay, a real change in who's holding the cards. The source uses this analogy I found striking, like watching your savings account deflate while you're just standing there. That really hits home, doesn't it? What does that feel like practically?
It's powerful because it makes it personal. Your home equity, for most people, isn't just numbers on paper. It's a huge chunk of their net worth. Years of paying the mortgage, market helping out.
Right.
So seeing that value go down, even if you're not selling tomorrow, feels like your financial cushion is shrinking, practically. It means less money you could pull out if you needed to sell or refinance or get a home equity loan. And there's an opportunity cost, too. If equity's shrinking, it's not growing to help with retirement or college funds or that business idea, you might have to rethink some plans.
Really underscores the stakes. Okay, so why is this happening? What's driving this shift? The sources point to a few things, starting with mortgage rates. They call them stubbornly hovering around 7%. How big a deal is that 7% number?
Oh, it's huge. 7%, especially compared to the rates people got used to, is a major roadblock. First, it just makes buying a house way more expensive month to month. Let's say a $400,000 loan. At 3%, you're maybe paying around $1,700 a month, principal and interest.
Mhm.
At 7%, that same loan jumps to over $2,600. That's almost $1,000 more every month. That prices a ton of people out of the market entirely, or forces them to look at much cheaper homes. Their buying power just plummets.
Wow, that's a massive difference. It's not just the number itself, but the jump from what was normal recently.
Exactly. And then there's the rate lock-in effect. You've got millions of homeowners sitting on these fantastic 2, 3, 4% mortgages.
Right, they don't want to give those up.
Why would they? If they sell and buy something else, they trade that amazing rate for today's 7% rate. So they stay put. That keeps existing homes off the market, which messes with supply. And potential buyers see 7% and think, maybe I'll just wait and see if rates come down.
So that lock-in keeps inventory tight in some ways, even as overall listings might rise. Interesting. Okay, beyond rates, the sources talk about broader economic, financial, and political uncertainties. How do these sort of vaguer feelings stop people from making a huge purchase, like a house?
Uncertainty is like kryptonite for big financial decisions. When people feel shaky about the economy, are we heading into recession? Is my job safe? Is inflation going to keep eating my paycheck? They get very cautious.
Makes sense.
Think about inflation numbers, like the CPI. If it stays high, even if it's not accelerating, people feel it every day at the grocery store, at the gas pump. Makes taking on a huge new mortgage payment feel riskier. Recession fears mean layoff worries. And, election years often bring a wait-and-see vibe. People pause big moves until the political landscape feels a bit clearer. Buyers end up wanting that crystal ball the source mentions, but, well, nobody has one.
A lot of reasons to hesitate. But if buyers are nervous, why are sellers still listing homes? Wouldn't they want to wait too? What's pushing them into this tougher market?
Sellers have different pressures. A big group is always the life event sellers. They have to move. Job change, divorce, family expanding, needing to downsize for retirement. Life happens, market conditions are not.
Okay, the unavoidable moves.
Right. Then you have others, like the source suggests, who are maybe trying to cash in before things get shakier. They saw huge gains on paper over the last few years, and they want to lock that in before prices potentially fall further. They're worried about losing that equity or even ending up owing more than the house is worth being underwater.
So, a mix of necessity and maybe a bit of fear of missing out on peak prices.
Yeah, or maybe fear being left behind if the market really softens. It creates this imbalance.
Hmm.
Hesitant buyers meet motivated sellers, pushing us towards that buyer's market.
Okay, so high rates, uncertainty, motivated sellers. It creates this cycle. Can you walk us through that loop? And how long does it typically take for rates to come back down? The source says they're first to feel the pinch, last to recover.
It's a feedback loop, really. High rates, less buyer demand, homes sit longer, inventory piles up, prices drop to attract buyers, lower prices erode existing homeowner equity. Some owners get nervous and list their homes to avoid further loss, even more inventory.
And it keeps going.
Until something breaks the cycle, usually the Fed getting inflation under control, which allows them to ease up on interest rates. But that takes time. Mortgage rates follow Treasury yields, which follow the Fed. Getting rates back down significantly usually means the Fed is convinced inflation is truly beaten and the economy is stable. That can take, well, sometimes years. They really are a lagging indicator of recovery.
That's a sobering outlook on the rate front. Okay, let's pivot to the equity itself, that golden goose. The sources say Americans have record-breaking amounts, trillions of dollars. Sounds amazing on the surface.
It really is an astonishing figure. We're talking trillions in collective home equity. Companies like CoreLogic track this stuff. And the gains, even recently, have been huge. For many, many homeowners, this is the bulk of their net worth, built patiently over years. It shows the power of homeownership as a wealth builder, no doubt.
But then comes the kicker, as the source puts it. As the market shifts, that equity could start slipping through your fingers like sand. That sounds pretty bad. What's the real impact there?
It is alarming, and the sand analogy works. If home prices dip, even just a bit, your equity value drops proportionally. Say your $500,000 home had $200,000 in equity. If the value falls 10% to $450,000, your equity shrinks to $150,000. Poof, 50 grand gone from your net worth, on paper at least.
Oh,
Right. It's not a realized loss unless you sell right then. But it shrinks your available capital, less you can borrow against, less cushion you have. The worry is that slow erosion of wealth, that equity you counted on for future plans. It could be systematically reduced if the market softens significantly. It's not just a number. It could impact your future financial freedom.
And it's not even always easy to get to that equity, right? The sources say tapping into it has challenges, especially now. What gets in the way?
The biggest hurdle right now, as mentioned, is often those high mortgage rates. If you have a fantastic 3% rate on your main mortgage, doing a traditional cash-out refinance where you replace that loan with a new, bigger one at 7%, well, the math often just doesn't work, like the source says.
Right. You don't want to lose that great rate on your home mortgage just to get some cash out.
Exactly. You'd be paying way more interest on the entire loan balance, possibly for decades, just to access a fraction of your equity. That higher monthly payment can be a deal breaker for a lot of homeowners. They'd rather keep the low rate, even if it means leaving the equity untapped for now via that method.
So the refi route is less appealing. What about other obstacles like this debt to income ratio or DTI? How does that play in?
DTI is huge for lenders. It's your total monthly debt payments, mortgage, car loans, credit cards, student loans, plus the proposed new loan payment divided by your gross monthly income. Lenders have limits, usually wanting your total debts back-end DTI under, say, 43% or maybe 50% of your income. So even if you have tons of equity, if you've taken on more debt since you bought the house, or maybe your income hasn't kept pace, your DTI might be too high to qualify for any new loan, whether it's a cash-out refi, a home equity loan, or a HELOC. You could be equity rich, but still unable to borrow against it because your current cash flow doesn't meet the lender's standards. It's about your ability to handle more debt right now.
So it's a double whammy. Potentially high rates make it expensive, and high DTI might make it impossible. But then the sources talk about when tapping equity becomes a power move. What's the sweet spot?
Yeah, there are conditions where it makes a lot of sense. Two key things the sources highlight. First, you plan to stay in the home for a while, like at least the next 5 years.
Why the 5-year horizon?
It gives you runway. Time for the market to potentially recover if it dips further. Time for your investment, whatever you use the equity for, to pay off. It smooths out short-term volatility and reduces the risk of having to sell at a bad time. It's about playing the long game.
Okay, stay put. What's the second condition?
Second, you should have a really strong equity position, ideally over 50% equity in your home.
50%. Wow. Why so much?
That provides a massive safety cushion. If your home value drops 10%, 15%, even 20%, you're still nowhere near being underwater. You still have significant positive equity. It makes you a much lower risk for lenders, potentially getting you better terms, and it gives you peace of mind. It means you're borrowing from a position of real strength.
Got it. Long-term plan, substantial equity cushion. And this leads to that perspective shift I liked. Your home isn't just shelter, it's a financial asset that can work for you. That feels empowering.
It really is. We get attached to our homes emotionally, naturally, but purely financially, it's likely your biggest investment. Thinking of it as an asset you can manage, leverage, make work harder, that's key, especially in a shifting market. It encourages being proactive, making strategic choices instead of just reacting or doing nothing, turning that dormant value into something dynamic.
I like that dynamic, not dormant. Okay, let's get into the do's. The sources mention home equity loans and HELOCs as the main tools. And they stress using them strategically for wealth building, not just, random spending. What's the crucial difference there?
It comes down to purpose and outcome. Impulse spending is usually for things that lose value or disappear. Fancy vacations, new gadgets, stuff that feels good now but doesn't build future wealth. Strategic leveraging means using that borrowed money to create more value.
How so?
By investing it in something that will either generate income, appreciate in value, or significantly cut your expenses. The goal is for the return on that investment to be higher than the interest you're paying on the loan. That's how you turn debt into a tool for getting ahead rather than falling behind. It's the difference between good debt and bad debt, essentially.
Making the money work harder than the cost of borrowing it. Got it. Okay, first do. Eliminating high interest debt. Sounds obvious, but break down the mechanics. Why is tackling, say, 20% credit card debt with an 8% home equity loan such a win?
It's often the biggest immediate win because the math is so compelling. Let's say you have $25,000 in credit card debt at 22%. That's costing you like $5,500 a year just in interest. You're barely touching the principal.
Wow, yeah.
Now, you take out a home equity loan or use a HELOC at maybe 8%. You pay off those cards. Now you're paying 8% interest on that $25,000, which is $2,000 a year. You just saved $3,500 a year in interest payments. That cash flow is freed up. You can pay down the principal faster, save, invest. It's a massive improvement to your financial health. Plus, it usually helps your credit score, too.
So huge savings and frees up cash. Powerful. What's the second strategic do?
Second is using the equity for home upgrades, but and this is key upgrades that actually boost the home's market value.
Mm.
You want a return on that investment.
Not just things you like personally, but things future buyers will pay more for, like the kitchen or HVAC system the source mentioned.
Exactly. A modern kitchen remodel is almost always a winner. Buyers focus there. You often get back 70–80%, sometimes more, of what you spend when you sell. Updated bathrooms, especially adding one, also have great ROI. An energy-efficient HVAC system saves money month to month and is a big plus for buyers. Same with good windows, maybe adding square footage if feasible, or improving curb appeal.
Things with tangible value.
Right, it's strategic. You get to enjoy the nicer kitchen or lower energy bills now, and you've increased the underlying value of your biggest asset. It's a win-win if you choose the upgrades wisely, thinking about what buyers in your specific area value most.
Smart. Okay, third do, investing in income-producing assets. This feels like leveling up the strategy.
It is, but it follows that core principle. Make the equity generate more than it costs. The idea is to use that borrowed capital to acquire something that throws off cash or appreciates faster than your loan interest rate.
Like buying a rental property. The source mentions Florida's hot rental market.
Precisely. Use equity for a down payment on a rental. In many areas like parts of Florida, rents are still strong, even if the sales market is cooling. People still need places to live, and high buying costs push more people to rent. So you buy a property, the rental income covers the mortgage, taxes, upkeep, maybe even leaves you cash flow positive.
And the tenants are basically paying off your loan over time.
Exactly. Plus, you get any appreciation in the rental property's value. It's using leverage smartly. Of course, you need to do your homework on the local rental market, understand landlord responsibilities, or budget for a manager.
Makes sense. What about investing in a small business?
Also a great option if you have an entrepreneurial streak or a solid plan. Using home equity can be cheaper and easier than traditional business loans, and you don't give up ownership. Starting an online store, funding a service business, expanding something you already run. If the business succeeds, the returns could dwarf the loan interest. High potential reward, but also higher risk, obviously. Needs a solid plan.
And the last example under this do was a diversified stock portfolio, aiming for those historical 7–10% returns.
Right. This is for someone who's comfortable with market investing but maybe doesn't want to be a landlord or run a side business. You invest the equity in a mix of stocks, bonds, maybe REITs, those real estate investment trusts that let you invest in property without owning it directly.
How does that beat the loan cost?
Well, history suggests a diversified portfolio averages maybe 7–10% annual returns over the long haul. If your equity loan costs you 8% and your investments reliably return 9% or 10%, you're making money on the spread. It's called positive arbitrage. The investment earnings cover the loan interest and then some. Requires patience, diversification, and sticking with it long-term for compounding to work. Maybe working with a financial advisor too.
Okay, so using leverage to capture market returns. Interesting. What's the final strategic do?
The fourth one is investing in yourself, education, or career growth. Using equity to boost your own earning power.
So like funding a degree, a certification, a coding boot camp.
Exactly. Think about it. A specialized skill or degree could lead to a promotion, a new higher-paying job, a whole career change. That jump in salary could quickly repay the cost of the loan and then continue boosting your income and net worth for years.
Like a stepping stone, as the source says.
Yeah, it's investing in your human capital. Maybe the best investment you can make. That $10 or $20K salary bump per year, that's a massive return on investment over your career, likely far exceeding the loan interest. It's leveraging your house to build a better financial future through your own skills.
That's a really compelling way to think about it. Okay, we've covered the smart moves. Now, the crucial don'ts. The sources warn strongly. Home equity is not a personal ATM. That really hits the need for caution. Right?
Absolutely critical. It's tempting when you see that chunk of available cash, but treating it like free money is dangerous. Remember, it's a loan secured by your home. If you spend it unwisely and can't pay it back, you could lose your house. It demands discipline, careful planning, and using it for things that build value, not just disappear.
So what's mistake number one to avoid? Splurging on depreciating assets. What are those, and why is this so bad?
Depreciating assets are things that lose value over time, usually starting the moment you buy them. The source nails it. Shiny new boat or luxury car. A new car loses a huge chunk of its value driving off the lot. Boats cost a fortune in upkeep, and their value just sinks. Think expensive electronics that are outdated in a year, lavish vacations with nothing to show afterward but the bill.
And using equity for this diminishes wealth, leading to buyer's remorse.
Precisely. You're borrowing money, paying interest on it, to buy something that's becoming worth less every day. It's the exact opposite of investing. You end up deeper in debt with nothing of lasting value to show for it, just the monthly payment reminding you of the mistake. That's a recipe for regret. You're literally paying interest on something that's shrinking your net worth.
Oof. Okay, clear warning there. What's the second big don't?
Overborrowing. Just because the bank says you can take out $100,000 doesn't mean you should.
Seems simple, but I bet it's easy to get tempted by that big number, especially if money feels tight. What's the real danger?
The danger is taking on more debt than you can comfortably handle month after month. The bank approves you based on formulas, but you know your actual budget, your spending habits, your tolerance for financial stress. You need to be realistic. Borrow only what you can comfortably repay is the rule.
How do you figure that out?
Look hard at your monthly budget. After all essential bills, existing debts, and savings goals, how much is really left over? Can you handle that extra few hundred or maybe $1,000 for the new loan payment without feeling squeezed or sacrificing other important things? What if an unexpected expense pops up?
And the benefit of being conservative here.
Peace of mind. Keeping payments manageable avoids that constant financial stress. It reduces the risk of missing payments, wrecking your credit, or worse, facing foreclosure if things go south. Overborrowing, even for a good reason, can turn a potential positive into a nightmare if the repayment becomes a burden. Prudence is key.
Know your limits, got it. And the final, maybe most crucial, don't. Don't ignore the risks. What's the number one risk they highlight?
The big one is that home prices could fall further. If you borrow heavily against your equity and then your home's value drops significantly, you could end up underwater.
Underwater, that sounds bad. Explain what that means practically for a homeowner.
It means you owe more on your total mortgage debt, your original loan, plus the home equity loan, or HELOC, than your house is currently worth on the market. Say your home is worth $350,000 now, but you owe $300,000 on the first mortgage and just took out a $75,000 equity loan. You owe $375,000 total. You're $25,000 underwater.
And why is that such a problem?
It traps you. If you need or want to sell, you can't just sell it and walk away. You'd have to bring $25,000 of your own cash to the closing just to pay off the loans. Most people can't do that, so you're stuck. Or you face really damaging options like a short sale, which hammers your credit, or even foreclosure. It kills your flexibility and turns your biggest asset into a huge liability.
A really tough spot. So how do you guard against that major risk? What's the advice?
It comes back to that strategic thinking and a long-term perspective. Be realistic about the market. Understand prices can go down. Don't borrow right up to the absolute limit of your equity. Leave a buffer. Stress test your finances. What if prices drop 10%, 15%? Would you still be okay? Do you have savings? And crucially, plan to stay put for the long haul, like those 5+ years we talked about. That gives the market time to recover from any dips. It's about being informed, cautious, and prepared for bumps in the road.
Eyes wide open, basically. Okay, let's make this real. The sources use an example. Homeowner in Orlando, $150,000 in equity, plans to stay, wants to make the money work. Sounds like our ideal candidate.
Exactly. Solid equity, long-term view. They're in a position to be strategic. Let's say they want to build some extra income, maybe get out of the 9 to 5 eventually. The sources give 3 potential paths for them.
Okay, scenario 1. Start a side hustle using $50,000 of that equity. What kind of hustle and how does it pay off?
Could be anything, really. The source mentions a food truck, an online shop, maybe consulting, something they're passionate about or skilled in. They use the $50 401k for startup costs, inventory, equipment, marketing. The key is the potential return. If that side business starts generating, say, $2,000 a month in profit.
That's $24,000 a year extra.
Right. Now compare that to the loan payment. A $50,000 equity loan at 8% over 10 years might cost around $600 a month. That $2,000 income easily covers the $600 payment, leaving $1,400 extra cash flow each month. That equity isn't dormant anymore. It's actively generating income and building wealth. It's a calculated risk, but with potentially huge upside.
Nice. Turning equity into income. What's scenario 2 for our Orlando homeowner?
Scenario 2 is using more equity, $100,000, as a down payment on a rental property. Source suggests maybe a duplex in Florida's still hot rental market.
Why a duplex? And why rentals if the sales market is cooling?
Duplex gives you 2 rental incomes from one purchase, a bit safer if one unit is empty. And yeah, while buying might be slowing, renting is often still very strong in desirable areas. High home prices and rates push more people into renting for longer. So our homeowner buys maybe a $400,000 duplex with that $100K down.
And the benefits.
Multiple. The rent collected should cover the mortgage payment on the duplex, plus taxes and insurance, maybe even generate positive cash flow month to month. The tenants are effectively paying down the loan for you. And over the long term, the property itself likely appreciates in value. So you win through debt reduction and appreciation. That's the cha-ching the source mentions. Leverage working beautifully.
Okay, building assets with assets. What's the third option?
Third is diversifying into the market. Taking $75,000 and investing it in a mix of stocks, bonds, maybe those REITs we talked about. This is more passive for someone who doesn't want to run a business or be a landlord.
Remind us of the potential return there and why it works against the loan cost.
Again, looking long-term, diversified portfolios have historically returned somewhere in that 7–10% annual range. If you're borrowing that $75,000 via a home equity loan at, say, 8%, and your investments average 9% or 10%, you're making money on the difference.
The spread.
Exactly. The investment returns are paying the interest cost and then some, growing your overall net worth over time through compounding. It requires discipline not to panic sell in downturns and usually benefits from a long time horizon, but it's a proven way to make capital work for you without active management.
3 really concrete ways to make equity productive. And the big takeaway is crystal clear. Make sure your equity is doing something for your wealth, not just sitting there or worse, being spent on things that vanish.
That's the core message. Shift from just having equity to actively managing it as a resource. Use it strategically, thoughtfully to accelerate your financial goals. Spending it on depreciating things destroys wealth. Investing it wisely compounds wealth. Huge difference.
Which brings us to the urgency. The sources say now's the time to act strategically, and waiting could cost you. Why the rush? What's the cost of doing nothing right now?
Well, a couple of things. First, if home prices do continue to soften, that equity you have today might be less tomorrow. Waiting could mean having less available capital to work with when you finally decide to act. That $150K in equity might become $140K or $130K. Opportunity shrinking.
Okay, erosion risk. What else?
Interest rates.
Yeah.
While they're high now, there's no guarantee they'll drop significantly anytime soon. They could stay flat. They could even creep higher. Waiting might mean facing even more expensive borrowing costs down the road, making these strategic moves harder or less profitable. Doing nothing means potentially watching your asset value decrease while the cost to access it stays high or increases.
So inaction has its own risks, and this loops back to empowering the listener. For homeowners in that sweet spot, significant equity, long-term plan, exploring a home equity loan or HELOC now is crucial. How should they view these tools?
As potential tickets to financial freedom, but with a big asterisk, if you play it smart. They are powerful tools, not magic wands, used wisely for the strategic doors. We discussed debt consolidation, value-add renovations, income-producing investments, self-investment. They can genuinely accelerate your path to financial goals. They put you in the driver's seat.
Which leads to that final thought. The market's going to do what it does, but you don't have to just be along for the ride. You have this asset, you have options, you have power. It's about taking control, isn't it?
Absolutely. It's easy to feel powerless when you hear about market shifts and economic headwinds. But if you're a homeowner with equity, you're actually in a position of considerable strength. You have a resource. It's about understanding it, exploring your options responsibly, maybe getting some professional advice, and making proactive choices instead of reactive ones. You can navigate these changes and potentially come out stronger. The power really is there to shape your financial future.
Fantastic. What a comprehensive look at this. We've really covered the waterfront today, understanding the shift to a buyer's market, especially in places like Florida and Georgia, and grasping the sheer scale of home equity out there, but also its vulnerability.
And hopefully clarify those crucial do's versus don'ts for tapping into it, making sure it's used to build wealth-clearing high-interest debt, smart home upgrades, income-producing assets, career growth rather than draining it away.
Right. Avoiding the pitfalls of splurging on things that lose value or borrowing more than you can truly handle. Those real-life examples, like the Orlando homeowner starting a business or buying a rental, really show the potential for equity to be this dynamic engine for growth.
And the message is timely. Don't just sit on the sidelines. Waiting could mean losing equity value or facing higher rates later. For those in a strong position, exploring these options now strategically could be a game changer. A real path to greater financial well-being if done right.
So here's something to mull over as we wrap up. In this constantly changing financial landscape, how are you going to ensure your home equity becomes more than just a number? How will you make it an active force driving you towards the financial future you want? Thanks so much for joining us for this deep dive. We'll catch you next time.